Good evening, and welcome to the Crypto Overnighter. I'm Nikodemus, and I will be your host as we take a look at the latest cryptocurrency news and analysis. So sit back, relax, and let's get started. And remember, none of this is financial advice. And it's Saturday, March 25th, 2023. And welcome to our 500th episode. Thank you for sticking with us. Custodia Bank tried to join the Federal Reserve System, but the Fed said no. The Fed thinks the bank's management and financial condition aren't good enough. Custodia mainly deals with digital assets, which the Fed doesn't like. The Fed doesn't want to mix digital assets with traditional banking because they feel that digital assets are too unstable. I would argue that given recent events, especially with Silicon Valley Bank, it was the traditional banking sector threatening crypto, and not the other way around. But I digress. The Fed is worried about banks that focus on only one area of the economy, a lack of diversification. The Fed is even more worried about Custodia Bank because it wants to offer products and services related to crypto assets, which they consider to be risky. The Fed looks closely at banks that want to join the Fed system or obtain some other type of charter. Now, Custodia did badly on their exam, at least according to the Fed. The order about the rejection was delayed because the Fed felt they needed to keep some information secret. The Fed found that Custodia Bank had problems with their risk management and controls for its banking activities. The Fed says that Custodia didn't do enough to manage risks and that they didn't comply with the Bank Secrecy Act and U.S. sanctions. They said Custodia also had issues with information technology, internal audits, financial projections, and liquidity risk management. The Fed said that they were concerned about Custodia Bank's lack of federal deposit insurance as well as its crypto-focused business model. The Fed said that the bank's plan was novel and not in a good way. They stated the obvious, saying that no other state member bank had been approved for it before. The Fed also doubted the bank's ability to make money in the future. They said Custodia's revenue sources were still being planned and policies and procedures related to crypto activities were still in early development, especially compliance. The Fed also said Custodia's revenue and funding depended too much on the crypto market. The Fed pointed to the bankruptcies of other crypto businesses as proof that the sector is unstable and unregulated. Which, really, how rich is it that the federal government, who could be regulating crypto, should be regulating crypto? Instead, that same federal government is standing in the way of innovation because they have chosen not to regulate crypto in any meaningful way. And then they use that condition as their excuse to withhold approval. But anyway, the Fed said stress in the sector could harm banks that focus on crypto. The Fed also said that Custodia's business activities were too risky even for member banks to take part in. Their position is, if Custodia fails, it would be U.S. taxpayers that are on the hook. Custodia's management had anticipated the rejection, and they sued the Fed months before. They accused the Fed of being biased against crypto after the Fed's decision was announced. And speaking of Custodia's management, the Fed found problems with them too. Custodia Bank spokesperson Nathan Miller said in an email statement that the Fed's order was as a result of procedural abnormalities, factual inaccuracies, and a general bias against digital assets. He also claimed that the Fed did not work with a bank that used a low-risk, fully reserved business model. Now, the Fed criticized Custodia's management, saying that their relevant banking and risk management experience was limited. The Fed found that the number and degree of shortcomings in Custodia's exam suggested the management did not have the necessary experience to match the intended risk profile of the firm. According to the Fed, approving Custodia's membership without deposit insurance would be an unprecedented move. The issue has been under more scrutiny in recent weeks after Silicon Valley Bank's failure. The Fed's order was written before Silicon Valley Bank's failure, and in that order, they highlighted Custodia's lack of deposit insurance, because that lack of insurance could increase the risk of a bank run. The order noted that Silvergate Bank, which is a crypto-friendly bank that also was state chartered and a member of the Fed, had faced problems due to its exposure to the digital asset industry through companies like FTX and Diem. So the Fed is being cautious in approving membership to its system, which provides access to low-cost liquidity facilities, and regulators are conservative in evaluating bank business models due to the potential for failure, which can lead to government intervention. Non-crypto fintech firms have also faced difficulties in gaining access to the Fed system. all of which means Custodia's legal battle against the Federal Reserve continues. The Kansas State Federal Reserve, the regional Fed bank named in the lawsuit, has requested an extension until March 28th in order to respond to Custodia's claims. Coinbase, meanwhile, has a fight against the Securities Exchange Commission. The company says that the US government's strict rules on crypto are creating a gap that other countries want to fill. And as we covered here on the show, the SEC sent Coinbase a Wells notice. Now, a Wells notice warns that the agency may take action against the firm. The notice relates the concerns that Coinbase may have violated securities laws in relation to some of its services, including staking and Coinbase Wallet. Daniel Seifert is Coinbase's vice president and regional managing director in Europe. Well, Seifert wrote a blog post on March 23rd. That post was called "Europe is Winning, Will the US Catch Up?" And in the post, Seifert said that the US had enforced crypto regulation instead of creating comprehensive regulation, totally ignoring industry-wide calls for comprehensive regulation. He also said that this approach has caused uncertainty and instability in the crypto industry. Seifert believes that the US is no longer the leading hub for crypto. Instead, France, the UK, and the European Union, they're all creating vibrant ecosystems by being more welcoming to crypto regulation. Seifert thinks that the US is losing out because of its strict approach to crypto regs. He wrote that the US has left a gap that other countries are waiting to fill. Eager. He added that Coinbase is an American company, and as such, it's hard to watch America miss out on this opportunity. Seifert talked about the importance of Paris Blockchain Week, and the celebration was held at the Louvre this month. He also mentioned the UK's efforts to become a crypto hub and the European Union's upcoming markets and crypto assets regulation. Seifert thinks that the fact that Paris Blockchain Week was held at the Louvre is significant. He said that this shows that France is welcoming the crypto industry and wants it to thrive. He also said that other countries like the EU, UK, UAE, Hong Kong, Singapore, Australia, and Japan are all doing the same thing. MiCA legislation has been under development for 2 years. The goal is to create a standard set of rules for crypto assets and related services. This move is expected to be positive for the European cryptocurrency ecosystem, in part because it will offer clear guidelines and rules for the sector. According to Seifert, Europe now has the same number of crypto developers as the US, 29% each one globally. Now, previously, the US was in the lead with 40%. He thinks that this level of growth is not by chance. Concerted efforts must be made to achieve it. Developing a regulatory framework is an example of one such effort. It will give businesses operating in the space clarity and stability. The Crypto Council for Innovation echoed Seifert's views in a long Twitter thread on March 23rd. They said that crypto is a global phenomenon, and no one is going to sit around and wait for the US to take action. The thread explored positive developments globally. For example, the National Australia Bank's use of non-US dollar-pegged stablecoins, and Hong Kong's efforts to become a digital asset hub. In the meantime, Cathie Wood's investment firm recently bought Coinbase shares again. This happened after the stock price of Coin decreased due to news of its Wells notice. On March 23rd, ARK Invest purchased over 260,000 Coinbase shares through 2 exchange-traded funds. These shares were valued at $17.88 million when the purchase was made. ARK Invest recently sold over 160,000 Coinbase shares. This was from its ARK FinTech Innovation ETF, and that was just 2 days before the news of the Wells notice broke. This sale was the first time any of ARK Invest's ETFs had sold Coinbase shares in 2023. Unfortunately, Coinbase's share price has not recovered since the news of the Wells notice. The notice warned of possible enforcement action, causing Coin shares to drop by approximately 21%. According to Barron's, Coinbase shares dropped to a low of $64.27 when trading began on March 23rd. At the time of writing, they were trading at $66.87 in after-hours trading. So Barron's provided a chart, and this chart showed that the share price of Coinbase from March 17th to March 23rd. During that same time period, Coinbase CEO Brian Armstrong sold shares in his company from March 17th to March 20th, just a few days before the Wells notice and the drop in share price. According to SEC filings, Coinbase executives and insiders enter their selling plans months in advance. The recent sales were part of a trading plan that was adopted on August 16th, so it's not like he had advance notice or anything. On February 9th, the SEC reached a settlement with crypto exchange Kraken after claiming that its staking services were securities. Coinbase, on the other hand, has argued that its staking products are fundamentally different from Kraken's and cannot be considered securities in the same way. The Financial Accounting Standards Board is proposing changes to U.S. accounting standards that would factor in crypto accounting. This would establish a fair value approach that measures certain digital assets based on their market value. Currently, only unrealized losses are marked, which the industry sees as a barrier to crypto adoption. This proposed change is a departure from the status quo and could lead to a more favorable environment for crypto in the U.S. accounting industry. The board's proposal would require companies to include gains and losses from assets like Bitcoin and Ether in their quarterly income reports. This would reflect swings in value each time a company files. The proposed changes are open to public comments until June 6th. They would also require additional disclosures about major crypto holdings. The long-awaited proposal could lead to more transparency in the reporting of crypto assets by companies. According to board chairman Richard Jones, the proposed changes to accounting rules for crypto would give investors greater transparency and additional disclosures. Currently, the approach only accounts for crypto assets as indefinite-lived intangible assets, which only focuses on drops in value. The board's proposal argues that this approach does not reflect the underlying economics of crypto assets or provide useful information for decision-making. The proposed changes could lead to a more accurate reflection of the true nature of crypto assets and their potential impact on companies' financials. Crypto advocates have reported that several UK crypto companies are facing challenges in accessing banking services. This is due to many banks limiting their interaction with the crypto sector. After the collapse of Silicon Valley, Silvergate, and Signature banks, US crypto clients have had to find new banking partners. However, the UK has been facing a similar issue as far back as 2021. This has resulted in a banking problem for crypto companies in the UK. Sue Carpenter is the Director of Operations at Crypto UK. She wrote a letter to the Treasury's Economic Secretary, Andrew Griffith, stating that many UK banks have now implemented bans or restrictions on crypto. Carpenter expressed concern that other banks and payment service providers may also follow suit. Crypto UK is a lobbying group advocating for digital assets. Several people have taken to Twitter to complain that UK banks are banning transfers to crypto exchanges. Lisa Cameron is a member of Parliament and is the chair of the Crypto and Digital Assets Group. And she confirmed that crypto businesses are struggling to open bank accounts with Santander and NatWest Group. Cameron has recently raised this issue to Parliament. According to a spokesperson from NatWest, the bank does not presently offer banking facilities to businesses that buy or sell cryptocurrencies. However, the bank's stance on this matter is under constant review since the crypto sector is rapidly evolving in the UK. A spokesperson from Santander said that the bank assesses onboarding new businesses on a case-by-case basis. The decision is based on the specific details of each business. So what we find is that UK banks have been distancing themselves from crypto in recent years. Alison Rose is the CEO of NatWest. In a hearing back in February, Rose informed the House of Commons Treasury Committee that the bank was preventing retail and wealth customers from transferring funds to crypto assets. Rose cited volatility, platform stability, and fraud as the reasons for the decision. To protect consumers from so-called crypto criminals, NatWest announced via email in March that they would limit customer payments to crypto exchanges. Customers could only transfer up to 1,000 British pounds per day, and no more than 5,000 British pounds over a 30-day period of time. To safeguard their customers from potential risks, several other banks have chosen to restrict crypto payments to exchanges. Gosh, isn't that so nice of them? Nationwide and HSBC announced restrictions of crypto purchases around the same time. Santander, by the way, is a Spanish bank with branches in the UK. They limited transactions to crypto exchanges to 1,000 British pounds per transaction last year. Meanwhile, Starling Bank is a UK-based bank, and they confirmed that they no longer support the buying and selling of cryptocurrencies by debit card or bank transfers. The bank also revealed that they never directly banked crypto companies. Yesterday, European banks faced fresh concerns about their future, especially as Deutsche Bank shares dropped more than 7% on the New York Stock Exchange. This after a tough day on Frankfurt's markets. The cost of insuring against the possibility that Deutsche Bank might default on its obligations increased significantly. This caused the German bank's 5-year credit default swaps to surge by 19 basis points from the previous day, reaching 222 points by the end of the day. Reuters reported that the bank's swaps had already risen to 173 basis points on March 23rd, up from 142 on the previous day. Now, according to Investopedia, an investor can use a credit default swap to exchange or mitigate their credit risk with another investor. Lenders who are concerned about a borrower's default often utilize these swaps to hedge their risk. Typically, during periods of uncertainty, market participants usually charge a higher price for that protection. However, worries about European banks go beyond just Deutsche. On March 24th, UBS's 5-year swaps rose by 14 basis points, reaching nearly 130. Granted, not as bad as Deutsche, but still. Now, just a few days before, UBS had acquired its troubled competitor Credit Suisse for $3.25 billion. This was part of an emergency ordinance to prevent financial market instability in the region. The Swiss National Bank has pledged to provide UBS with over $100 billion in liquidity under the agreement. Even so, the rescue of Credit Suisse has failed to alleviate the widespread investor concerns about the European banking system. On March 24th, shares of Commerzbank fell by as much as 9%, while Societe Generale and UBS dropped more than 7% in European trading. Now, Deutsche Bank shares have decreased by more than 25% in the last 30 days. The problem is that so many banks got caught up in a duration trap of sorts. This was because they bought long-dated bonds that have since seen their value demolished by the Fed's rate hikes. On March 10th, the US-based Silicon Valley Bank collapsed. This caused regulators in the US and the UK to intervene to prevent a possible ripple effect throughout the banking system. And I just want to leave you with this last thought. As the banking system faces uncertainty, Bitcoin remains steady, trading at around $28,000 at the time of writing, seeing a 17% increase in the value of the last 30 days. I think Bitcoin has performed really well considering the current environment. I think this is a testament to its value as a decentralized and secure store of value with a limited supply. And this night, as I have done 499 other times, I want to thank you, my listeners, because when you stop listening, I will stop talking. If you enjoyed tonight's show, please like, follow, subscribe, leave a rating or a review. And in the meantime, we will see you again tomorrow night.